Okay, let's just take a breath. It is Tuesday, January 20, 2026.
Mm-hmm.
And if you've glanced at your news feed, and I really hope you haven't, your 401k this morning, you probably feel like you've woken up in a simulation that's, glitching out.
Glitching out is putting it mildly. I mean, this feels more like the servers are melting down. We are seeing market moves today that we haven't seen in decades.
Decades. The Dow is bleeding, gold is charting a vertical line, and the geopolitical map. It feels like someone is trying to redraw it with a crayon.
Or maybe a Sharpie. Look, the headline alone sounds like a bad SNL skit from 10 years ago.
Right. The President of the United States has issued an ultimatum to Denmark. Sell Greenland to the U.S. or else.
Well, and it's not just Denmark in the crosshairs, and that's the absolute key here.
No.
If this were just some bizarre real estate deal gone wrong, the markets might chuckle. But we are looking at a threat against 8 of America's closest European allies.
Okay, so before we spiral, let's set the table. The mission for this deep dive isn't to just gasp at the headlines. We need to unpack why the financial markets are treating this as a catastrophic structural shift.
It's not just noise.
It's not just noise. We've got a massive stack of sources today. We're pulling from Reuters market data, a really intense report from the Global Banking and Finance Review, and some fascinating analysis from European Business Magazine on defense stocks.
And we also have that critique from the American Institute for Economic Research, the AIOR, which basically takes a red pen to the entire economic logic of this deal.
And the one that honestly scared me the most, a machine learning analysis from BBVA Research. It explains why the algorithms are freaking out even more than the humans.
That BBVA paper is the linchpin. It really is. It explains the mechanics of the crash. But let's just start with the scene on the ground. It is Jan 20. The Dow and NASDAQ are down over 2% intraday.
And this phrase is everywhere I look. The Sell America trade. Now, usually when people panic, they buy dollars, they buy U.S. Treasuries. That's the safe haven. But that is not what's happening today, is it?
No, and that is the terrifying anomaly. The Sell America trade means investors are dumping U.S. stocks, they are selling the U.S. dollar, and they are offloading U.S. Treasuries. The dollar index, the DXY, is just taking a nosedive.
So if they aren't buying dollars, where is all that money going?
It's fleeing to the last vestiges of, neutrality. Gold has hit an absolute record high, smashing through $47.50 an ounce.
Wow.
We're seeing flows into the Swiss franc. And usually you'd see money flow into the Japanese yen, but we'll get to why that safe haven is broken in a bit.
Okay, so the market is screaming that the U.S. is no longer safe.
Right.
Why? Walk us through the specific catalyst from this past Saturday.
It was Saturday, January 17. President Trump issued the statement. It wasn't vague at all. He demanded the, quote, complete and total purchase of Greenland.
Which Denmark has rejected. I mean, repeatedly.
Repeatedly. But here's the stick. He said, if there is no deal, the U.S. will impose a 10% tariff on all goods from Denmark starting February 1st, 2026.
That's just over a week away.
And then he escalated it. If there's still no deal by June 1, those tariffs go to 25%.
Okay, that's bad for Danish butter cookies and Legos. But why is the whole world crashing? I mean, Denmark's a small economy.
Because the threat didn't stop at the Danish border, the statement explicitly extended those same tariff threats to 8 European allies who publicly supported Denmark's refusal.
Who are we talking about?
We were talking about the UK, Germany, France, Sweden, Norway, Finland, and the Netherlands, the core of Europe.
So let me just get this straight. The United States is threatening a trade war against NATO, its own military alliance.
Precisely. And that is why the Global Banking and Finance Review says investors are struggling to price regime change.
Regime change. That usually means a coup in some small country.
Well, in this context, they mean a regime change in the global order. The post-WWII economy was built on the assumption that the U.S. and Europe are on the same team. If the U.S. is willing to sanction Germany over a land purchase, then the risk premium for holding U.S. assets just changes overnight.
The entire trust model is broken.
It can't trust the alliance structure anymore. That phrase in the report, the calm has fractured. It really feels appropriate, doesn't it?
It does. But here's where it gets confusing. The general market is bleeding out. Tech is down. Consumer goods are down. But there is one sector that is absolutely ripping higher.
European defense.
Yeah. I was looking at the numbers from European Business Magazine. The Steel XX Europe Aerospace and Defense Index is up 13% just since New Year's Day.
Which is a massive move for what's usually a boring industrial sector.
But the individual companies are even crazier. Rheinmetall in Germany up almost 24%. BAE Systems in the UK is up 21%. And Saab in Sweden is up 28% in 3 weeks.
Saab is the real standout. They're up nearly 200% over the last 12 months.
Okay, but play devil's advocate for a second.
Mm.
Is this just a knee-jerk reaction? Traders see a headline with the word conflict and just blindly start buying tank stocks? Or is there something more structural here?
No, this is structural. Bernstein analysts are calling it a super cycle, but the sources are calling it something else.
What's that?
The permanent war economy.
That sounds incredibly dystopian.
It is, but the logic is sound. European nations are realizing in real time that they can no longer rely on the U.S. commitment to NATO.
I mean, if Washington is willing to weaponize tariffs against you, can you really trust them to send aircraft carriers if you're attacked?
You probably can't. So Europe is decoupling. Historically, U.S. companies like Lockheed or Raytheon, they held about 60% of the European market. That is ending.
So it's a real shift in procurement.
Look at Denmark itself. They used to buy American gear. Now, they're awarding huge combat vehicle contracts to BAE in the UK and Rheinmetall in Germany. They're buying air defense systems from Norway.
So this isn't just we need more weapons, it's we need non-American weapons.
Exactly. It's a full-on push for strategic autonomy. Investors are betting that Europe is going to rebuild its entire military-industrial base from the ground up to ensure they are never dependent on a U.S. president who views them as a piggy bank.
And there was a specific trigger for this defense spike too, right?
Yeah.
Besides the threat itself.
Yes. There were joint military exercises in Greenland. They involved Germany, France, and the UK. Officially, the press release said it was just for Arctic training.
Very convenient timing.
Very. Symbolically, it was a shield wall. It was Europe saying, we are physically here and we support Danish sovereignty. The markets saw that standoff and said, okay, the Atlantic Alliance is breaking and Europe is arming itself. And boom, the stocks took off.
Okay, so we have the market meltdown on one side and the defense boom on the other. But we have to talk about the prize itself. Greenland. I get that it's big, I get that it's strategic, but is it really worth blowing up 70 years of diplomatic relations over? What is actually there?
Well, it's not about the ice, it's about what's under it. We're talking about geoeconomics. Greenland is sitting on a massive, massive reserve of rare earth elements, RBs.
Which we need for, well, everything.
Everything. Electric vehicles, wind turbines, iPhones. But most critically for this discussion, missile guidance systems and fighter jets. The U.S. is terrified of Chinese and Russian influence in the Arctic. They see Greenland as the ultimate strategic high ground.
But I was reading that economic critique from the AIR, and the math on this deal seems, it seems delusional.
It is. They call it the valuation paradox. The reports suggest the U.S. is offering something in the range of $500 to $800 billion.
$500 billion. That sounds like a lot of money.
It does sound like a lot, but estimates suggest the resource wealth in Greenland, if you could ever fully develop it, is anywhere from $2 trillion to $4 trillion.
So it's a lowball offer.
It's insultingly low. But the AIER brings up a crucial point about option value. Think of it like a lottery ticket or a tech startup.
Okay.
You don't sell a startup that holds the patent for cold fusion for the price of its office furniture just because you haven't built the reactor yet. Those resources are long-dated options. You hold them because their value in 2050 might be infinite.
Right. But even if the price were fair, the AIER article had this section about the symmetry test that I found just hilarious.
It highlights the absurdity perfectly, doesn't it? If we accept the logic that historic ties or strategic value allow you to force a purchase of territory, then the world map gets really messy really fast.
Yeah, they use Spain as an example. By this logic, couldn't Spain just slap tariffs on the U.S. and demand we sell them Florida back?
Exactly. We discovered it, would like it back now, here's a check. Or France demanding the Louisiana territory. We sold it too cheap in 1803, the valuation was off, hand it over.
Or Russia trying to claim Alaska.
And that's the really scary one. But the point is, modern economics relies on the idea that borders are not balance sheet items. You can't just buy a population and a government because you have a trade deficit you want to leverage.
It's treating sovereign nations like tradable assets.
And doing that introduces geopolitical risk into everything. If borders are now negotiable under tariff pressure, then no investment anywhere is safe. Which brings us to the most technical, but I think most important part of our stack.
The machine learning analysis from BBVA Research.
Yeah.
I'll admit, this was heavy. Geopolitical risk analysis via machine learning. But what I found so striking was that the AI models are predicting more chaos than the human analysts. Why is that?
Because human analysts, we tend to think linearly. We think, okay, a 10% tariff is bad, but we can manage it. The machine learning model looks at something different. It looks for nonlinear amplifiers.
Okay, you have to unpack that. What's a nonlinear amplifier?
Imagine a bridge. You can put one truck on it, that's fine. Two trucks, still fine. But there is a threshold, a specific weight, where the bridge doesn't just bend a little more, it snaps. That's a nonlinear event. The BBVA paper argues that geopolitical shocks like this Greenland ultimatum act as that final truck.
But why now? Why didn't this snap the bridge 5 years ago?
Because of the context. The model identifies that these shocks matter most when economic policy uncertainty interacts with high financial volatility.
The VIX, the fear gauge.
Right. We already have high interest rates. We have a VIX that spiked 8% today. The global economy is already fragile, so the algorithm sees that when you inject a massive trade war shock into a system that is already shaking, you get a dangerous feedback loop.
So that sell American trade isn't just people panicking, it's algorithms executing a structural exit.
Precisely. The ML model predicts that the correlation between safety and the US dollar completely breaks down in this specific danger zone. The computer looks at the data and says, the US is the source of the volatility, therefore the US cannot be the hedge against the volatility.
That is a profound shift. And it seems like this contagion is hitting everyone. We touched on Japan earlier. You mentioned the yen isn't acting like a safe haven. What's going on there?
Japan is sort of the canary in the coal mine for this global debt crisis. They're in the middle of a snap election, which creates political uncertainty. But the real problem is the bond market.
Japanese government bonds, JGBs.
The so-called widowmaker trade. Investors are dumping JGBs. This spikes the yield, the interest rate the government has to pay. And Japan has a massive debt load. If their rates go up even a little, their interest payments explode.
Which creates a dune loop.
That's the one. They have to print money to pay the debt, which crashes the yen, which causes more inflation, which pushes rates even higher. So you can't hide in the yen right now because the Japanese system is cracking under the pressure of this global sell-off.
It really feels like there's nowhere left to hide.
Except gold and European defense stocks.
Well, maybe raw materials. We have to talk about the India angle. We saw that piece. It seems like this race for resources isn't just a U.S. versus China thing anymore.
No, and this is an underreported part of the story. The article detailed how private players in India giant conglomerates like Vedanta are aggressively bidding for critical mineral blocks.
This is from monazite, right? The rare earths.
Yes, but notice the shift. It's not just the Indian government doing this. It's private capital realizing that the global supply chain is dead. You can't rely on China to sell you these minerals. And now, apparently, you can't rely on the U.S. to maintain global order.
So if you're an Indian industrial giant, you have to go upstream. You have to own the mine yourself.
It's every nation and every company for themselves. It's a move toward autarky, self-sufficiency, which is terribly inefficient, by the way. It costs way more to build your own mine than to buy from an efficient global market.
But efficiency doesn't matter anymore.
Security matters. That is the permanent war economy writ large.
And meanwhile, Europe isn't just taking this ultimatum sitting down, are they?
Oh, absolutely not. The days of polite diplomatic notes are long gone. The EU is preparing what they are calling a trade bazooka.
I love that term, even if the reality is terrifying. What's in the bazooka?
93 billion euros in retaliatory tariffs. Ursula von der Leyen, the Commission president, used the word unflinching.
She had a great quote I wrote down. Plunging us into a downward spiral would only aid the very adversaries we are both so committed to keeping out.
And she's pointing out the supreme irony here. The U.S. wants Greenland to counter China and Russia. But by starting a trade war with its NATO allies to get it, the U.S. is fracturing the very alliance that holds China and Russia back.
You burn the village to save it.
And the market sees the smoke. That's why the Sell America trade is accelerating. If the U.S. treats its allies as enemies, then the U.S. dollar ceases to be the currency of the free world. It just becomes the currency of the United States.
So let's try to wrap this up. We have a fracturing NATO, a trade war between allies, a Sell America trend, and a defense sector that is literally pricing in permanent conflict.
It leaves us in a transition period. I mean, we are moving from a rules-based order to a transactional one.
And for the listener at home, why should they care about this? I mean, aside from their 401k dropping today.
Because of the risk-free rate.
Explain that.
In finance, the U.S. Treasury yield is the risk-free rate. It's the anchor for the entire global economy. It determines mortgage rates, car loans, business loans, everything. It's considered risk-free because the U.S. is stable and, plays by the rules.
But if the U.S. is now tearing up the rules,
then nothing is risk-free. The cost of capital goes up for everyone, everywhere. Your mortgage gets more expensive. Your imports cost more. Inflation becomes sticky. The stability premium the world has enjoyed for 70 years, it just evaporates.
It feels like we are watching a game of poker where someone just decided to flip the entire table over because they didn't like their hand.
Or they're betting that they own the casino, so they can just change the rules mid-game. But the other players, Europe, Japan, the bond vigilantes, they're all cashing out their chips and leaving the table.
So here's the question that keeps nagging at me. If European defense autonomy accelerates, if they really do decouple from U.S. suppliers like the sources say, are we witnessing the financial end of the Atlantic Alliance before the political one is even officially broken?
That is the ultimate provocative thought, isn't it? An alliance is only as strong as its interdependence. If Europe builds its own army, its own supply chains, and its own strategic autonomy because it fears U.S. coercion, then yes, NATO might still exist on paper in Brussels. But the financial and industrial tendrils that bound the West together for decades, they're being severed right now.
And once you build a tank factory in Germany, you don't just close it down because the political winds change in 4 years.
Exactly. Capital is sticky. Once those supply chains move, they don't move back. We are seeing the architecture of the next 20 years being built this week in real time.
Well, on that cheerful note,
Okay.
what are we watching for next?
The calendar, February 1st.
That's the deadline.
That is when the 10% tariffs kick in if there is no deal.
And June 1st for the 25% escalation.
Correct. But watch February 1st. If those tariffs actually go into effect, if it's not just a threat but it becomes reality, then the market reaction we saw today might just be the warm-up act.
We will be watching very closely. Thank you for walking us through this ice-cold crisis.
My pleasure. Stay safe out there.
And thank you for listening to